Hi everyone, thanks for tuning with me. This is Sandeep Anand. Mark Cuban recently made a very interesting statement like everyone is a genius in bull markets. So profound statement that is. And that's so true. We can see that, today's world, there is an impulsive, attraction alluring capital markets and stock market is so alluring for so many youngsters. And there is a big rush of millennial and Gen Z investors who are coming into the world. That's why we see the spike in the record number of account opening with Robinhood and many other platforms, and it's inching towards the peak of the bull market. Now we don't know when that will end. It's really close to impossible to time the market, so we don't know when the peak is going to be. It could be 1 year, 2 years away. It could be even as long or short as 1 month away. But the point I'm trying to make is, Warren Buffett has put it even better statement like, it's only when the tide goes out, we can see who is swimming naked. Such a brilliant statement. And unfortunately, most of the new generation of traders or investors try to enter into the market at the peak and try to make the money, quick money. And, it's the peak of the bull market in the last 1 year they enter in, which is a exact opposite time to enter in, and then the market collapses. 90-95% of these new age new generation investors flee the market and they never return back. That's a sad state of affairs because capital markets are so powerful to create wealth, and it's only one few for 2 to 3 to 4% of folks who stay through multiple decades and seen multiple cycles who make really the big money. And that's precisely why you have the cycles which are having the span of 8 years, 7 years gap. That's because a new set of investors come in, new set of traders come in and trying to time the market, because everyone's aunt and uncle are making money. Everyone wants to make quick money, and that's precisely what happens in the peak of the bull market. Now, it's really impossible to lose money in the stock markets if you really follow the fundamentals. And there are really two steps one needs to take to avoid losing money in the market. It is number one, diversification, and number two, staying through the long periods of time. When I say long periods, it could even be multiple decades. And here is analysis why I'm making such a bold statement that it's really impossible to lose money. Take a look at this analysis and you'll understand why. So time duration reduces the risk of loss in markets. So benefits of long-term investing, I have created this analysis. What I've done is I've gone ahead and taken data from S&P 500 index returns over the last 93 years. Starting with, you can see on the right side, I've categorized them into from 1927 all the way to 2020. So, it has been categorized into green and red zones and yellow zones. So primarily it's based on the positive returns and the negative returns. So what I've done is I've grouped them into buckets that is showing percentage of positive returns and percentage of negative returns. Now, what is interesting that when you chart this out of S&P 500 index, you could see in the graph 73% of time in the last 93 years average returns of S&P 500 were positive, and had an average S&P 500 index has returned an average of more than 10% during this whole tenure. You could slice and dice any period during this time, you will get approximate average returns of 10% over 5 to 6 years. That is the average of S&P 500 index. Now that has been the norm, and it's impossible to lose money that way, right? I mean, unless otherwise you invest at the top of a bull market like the one that is currently going on, or like the Nasdaq one in 2000. The Nasdaq did not return that value for many years. So but on an average, you have to we cannot time the market. So what we need to do is consistently invest money in any of these indexes over long periods of time, 20-30 years. Your returns can never be negative unless you invest in the top of the bull market. Now you look at it, S&P 500 has returned positive values are 73%. That's the three-fourth of the time a year. The S&P 500 return of index year returns over a year is positive. And majority of the time you look at this buckets, so I've categorically done that. For 4 years down, 4 years it has been down 25% or more. For 2 years it has been down 20 to 25%. For 0 years it's down 15 to 20%. 1 year is down 12 to 15. For 12 years it's down 5 to 12%. That's a maximum number of time it has returned negative 5 to 12% return for 12 years. And 6 years it's 0 to 0.1 to 5%. So overall, that those many years it has returned negative. Look at the positive returns. It is most of the years, three-fourth of the time, it has returned average of 10 to 15 percentage, and that is your average S&P 500 returns when you stay invested in the index long term. So there are 68 positive years averaging 21 percentage return, and there are 25 years in this 93 years averaging negative 13 percentage. So what is a message one can take? So anybody who invests for a long time, around 10 to 20 years, the average return is going to be positive. It will be anywhere between 10, 12, 15 percentage based on the time you enter and based on the amount that you incrementally save. So the key message takeaway from this is time in the market is more powerful than timing the market, and one can really never time the market all the time. It is possible sometimes, it by luck or by chance, whatever. Now there is also a key message that you can never lose money in the stock markets if you diversify across a broad set of indices or ETFs, or maybe even a stock portfolio of 15 to 20 stocks or 25 stocks. It's really impossible to lose money in the market over long periods of time. So give those are the two things, two steps. Diversify the total number of stocks or total number of ETFs or indexes that you invest in, and stay for the longer period of time, 15, 10, 15, 20 years. It's really impossible to lose money in the stock market. That's a key message I want to leave with my audience with. And trust this was helpful. Thanks for tuning with me.